Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to this edition of the Retail Focus Podcast with Trent and Leighton Kling. Coming up on today's show, as we mentioned during the week on our last Retail Focus Podcast, it's all an off-price edition today. Earnings from TJX, Ross, and Burlington. We'll talk about that all during this truncated Thanksgiving week edition. A reminder, you can like us, rate us, however you do access us, whether that's on Apple Podcasts, whether that's on Spotify, whether that's in any podcast delivery service. You can check us out there and, of course, rate us using that medium. The other thing you can do is check us out on Twitter and Instagram at Retail Podcast. Leighton will be in the San Francisco area, actually, this coming Thanksgiving Day and Black Friday, so he'll be posting some of his takeaways from there on those mediums as well. So, as we mentioned, the show comprised of 3 earnings calls from the off-price segment, a couple of which happening last week. Let's start with the first earnings call that took place last week with TJX. Going into that earnings call, and of course we'll talk about the numbers, but mainly going to talk about the initiatives for each of the 3 companies and how they kind of weave together. Earnings per share expectations from analysts sitting at 66 cents per share prior to the call, up from the previous year's 63 cents earnings per share for TJX. The news positive from the company. One of the only positive calls on Tuesday. You'll recall back to last Tuesday, Home Depot, Kohl's, Urban Outfitters all saw earnings below expectations. TJX was the exception. We'll talk about Ross here in a little bit, but as far as TJX is concerned, their fiscal 2020 third quarter numbers were solid.
Once again, it was steady growth for the off-price set of retailers. Nothing that would set the world on fire, but good growth in both revenue and comps for the segment nonetheless. Their comps came in at growth of 4% company-wide, which includes a 6% boost in their Europe and Australia divisions. Domestically, their Marmaxx division showcased comp growth of 4%. Their Marmaxx division, of course, is made up of TJ Maxx, Marshalls, and then Sierra Trading has actually been added as of late as well. However, it is important to note that their comps do not include e-commerce sales, as they do for some other retailers, meaning that the positive numbers here are strictly a function of brick and mortar sales, which we would expect. Of their divisions, only Sierra has a long-lived and effective e-commerce site, although Home Goods is improving their online presence as of late. Speaking of Home Goods, this division was up only 1% on comps domestically. This caught us by surprise since other retailers like Kirkland's, Pier 1, Bed Bath & Beyond are all among retailers really struggling in this space already. And while Wayfair is increasing sales, their losses continue to mount. Oh, by the way, Marmaxx was actually going against 9% positive comps from last year. So they are now at around 13% increase for a 2-year stack basis. As far as earnings per share is concerned, diluted earnings per share came in at 68 cents per share, beating those analyst estimates of around 66 cents. So beating analyst estimates by around 2 cents. This, along with their increase of full year earnings per share guidance, were likely driving factors in the stock trading up 2 to 3% on Tuesday after the call, even when going against other retail headwinds on that particular day. Their margin, which is always a huge topic of conversation for us, at least in the off-price sector, remained flat versus last year. So nothing good, nothing too bad. This is a net positive for the retailer overall, though. If you look with a pre-tax profit margin sitting around 10.7%, Trent, a continued strong number. A handful of analysts over the past few years have suggested that increased competition for deals amongst off-pricers might drive margins down, that and, of course, potential rent increases out there. But at least so far, TJ Maxx has actually been able to keep pace with any increases in cost of goods sold, partially because of a slight decline in selling general and administrative expenses as a percentage of sales versus last year. Speaking of sourcing, Trent, that brings us to pretty much our favorite topic for off-price retailers, deal flow. And this is something we talk about with all these bargain outlet. Deal flow is extremely important for TJ Maxx. And on the call, they said, or more specifically, Ernie Herrmann said, their CEO and president, that deal flow is incredibly strong for the retailer. Further, their robust cash position has really allowed them to take advantage of different deals available to them across the board. He called it fantastic widespread availability of quality branded merchandise. As such, this plays into their goal of pretty much ensuring high levels of inventory as holidays approach, which is good for them. Next couple months are going to be very, very important in order to keep transactions at a high number towards the end of December. To this point, Trent, as of November 2nd, they were carrying 9% more inventory on a per store basis than they were last year on a constant currency basis. And if you look, really including inventory in transit and in their distribution centers, they had $6.3 billion in inventory on hand versus just $5.5 billion last year. A major jump. This reaffirms the widely held belief that the struggles of department stores to drive traffic and sales is playing into the hands of off-pricers, with increased availability of deals for merchandise really stretching all the way back to manufacturers.
This is something that was a trend for all of the earnings calls that we'll talk about here on this episode, both TJX and Ross as well as Burlington, although only TJX saw the massive jump in terms of inventory, and we'll talk about how that relates to the other two retailers later on in the show. Now, as far as store growth for TJX, we saw a continued focus towards growing all of their banners. 29 total TJ Maxx and Marshalls stores were added, but they opened an additional 24 home goods stores as well. And the smaller brands, which we've been watching carefully, did grow by leaps and bounds in the quarter. Sierra alone saw 7 new stores opened in the third quarter, an 18% growth in store count just in that 3 months. Now, we continue to be very bullish on Sierra, and these numbers, of course, spell out the fact that the company is as well. The same could be said of HomeSense. Now, HomeSense, different from Home Goods. HomeSense, a new brand that they're starting to add stores to. 9 new stores were added in this last quarter. Those 9 new stores, by the way, again, account for over 25% of their current HomeSense store base. So they are very comfortable with their brands. They're very comfortable with all 5 of their brands to this point and growing them out. Now, in terms of categories, they admitted to home being a strong category for them, as we would expect. Now, it's interesting. They said home within the individual stores was a very strong category, but we only saw home goods with that incremental increase in same-store sales. But their home sales within TJ Maxx and Marshalls in particular, very strong. And they were clear, as far as these home sales were concerned, it's not so much brands on the product as it is trends that are helping to drive the category for them. And Ernie Herrmann on the call credited the buyers at TJX for being very spot on in terms of trendy merchandise and the fact that they're able to look beyond brands to bring valuable inventory into the fold is a big benefit for the company, one of the big reasons why that category is going up. Additionally, they said accessories, especially women's accessories, provided solid growth in this last quarter, and Herrmann noted that accessories in particular perform well around the holiday season. So he's excited for their momentum heading into the fourth quarter, a fourth quarter where, again, customers got more used to shopping accessories at TJX overall, at all of the brands overall, and he's excited for where that's at heading into the fourth quarter, especially with the increased inventory levels, feeling like they're well positioned to take advantage of that momentum. Now, speaking of momentum, he also noted that the solid third quarter sales are driving higher sales and margins in the fourth quarter so far. This is in large part due to the fact that clearance activity has been limited so far in Q4 because they were able to move so much product in Q3. So the fact that they didn't bring a lot of stale product into the fourth quarter, helping them out on the margin front, helping them because they're not having clearance so much product heading into the holiday season. Now, one final note about TJX, just last week, they finalized a 25% ownership stake acquisition of Familia. If you're not familiar with Familia, well, it's because they're a privately held company in Russia, but they are an off-price retailer, and TJ Maxx assured on the call this was a non-controlling minority stake, but it does give them the opportunity to invest in what they see as Russia's main off-price retailer, and they were asked about this on the call. Why do you see Russia as the market to invest in when there's all of these other markets out there? And leadership said, hey, this gives us an opportunity to get in on the ground floor of what they feel like is Russia's main off-price retailer in what they feel like is a growing off-price market. So that was some of the reason given for that investment. I don't know that we're going to see too much of Familia on future earnings calls because this is basically that non-controlling minority stake, but still something interesting to note for TJX, which again is a company on a very consistent incline. Now, after this, we'll come back and we'll talk about Ross's earnings.
Well, we promised you it was going to be an off-price retail sort of podcast, and we will continue on with Ross to try to keep that theme intact. As with TJX, when we discuss Ross, we are not only discussing Ross Dress for Less, but also the ever-growing DD's Discounts brand as they continue to gradually expand throughout the United States. However, unlike TJX, Ross offers very little transparency with performance across all of their brands. Zacks consensus estimates pegged earnings per share for the retailer at around 97 cents, which Ross handedly beat. And Ross came in with earnings per share at $1.03, which beat our expectations and honestly beat analyst marks by over 6%. This ended up making headlines at Barron's, which read, Ross disappoints, all the more confusing for those readers there. In any case, the beat on earnings per share was indicative of solid health overall for the company, as they were both more efficient on sales and more effective in bringing in sales, bringing in that all-important traffic. Speaking of traffic, on the comps front, Ross ended up boasting a sales increase of 5% over the third quarter of last year. This outpaced the comp gains we saw so far this year, making it an even larger bump than we had expected. In fact, their year-to-date comps still sit at around 3%, even after the 5% boost in the third quarter. This was a function of both higher traffic, which I was alluding to, and higher basket size, always a positive for the retailer. They said in the Q&A this was pretty much an even split. As far as the particulars, the different categories that they sell through driving the comps, they said they wouldn't really get into the details on the call, rather than to say that most categories were sequentially up, with the greatest improvement being in ladies' apparel, something that has been hit or miss over the last several years for them. So they brought in more in the way of sales, benefiting not only from those new store openings, which Trent always talks about, but the third quarter sales overall were up 8% as a function of those new stores. But as always, the question in the off-price sector is, did they erode margins by attracting those new sales? And the answer is no. In fact, their margins came in above guidance as well. Their operating margin was 12.4% in the quarter, mainly due to those solid sales numbers, but also, here's that word again, robust deal flow. Again, finding a lot of great deals to really amp up their supply chain network and increase the inventory in their individual stores. The increase in sales numbers allowed them to move more merchandise prior to markdowns, thus, of course, boosting the margin. The robust deal flow, meanwhile, helped out because their buyers were able to capitalize on both positive pricing and higher quality merchandise. Quality being pretty much the second time here we've seen a lot of stores talking about the quality of their merchandise. What kinds of brands are they bringing in to sell to their customers? Meaning merchandise margin was pretty much able to expand ever so slightly. We talked during their last quarter about how excited they were regarding their buyer success and how they had pretty much ample space for pack away in anticipation of not only great deals, as of course they have some trickle down from department store struggles, but also attempting to beat out the oncoming tariffs that we're seeing from China. They are now projecting full year earnings per share to be between $4.52 to $4.57 per share, an increase over their previous guidance of $4.41 and $4.50 per share. That's a healthy increase both on the bottom end and the top end of that guidance. This also makes Barron's headline look a little bit even more foolish there. If there was any reason for the bearishness maybe from Barron's, it was the reaffirmation of guidance for the fourth quarter as far as comps. They still expect 1 to 2% increases overall. This is due, according to the CEO, Barbara Rentler, to really lapping strong sales numbers in previous fourth quarters. We get that. It's a little bit hard to come up against stronger previous years. Additionally, they said on the Q&A that they are pretty much concerned about the potential impact an isolated weather event might have with the shorter shopping season.
So a couple of things I wanted to note about this particular guidance. As Leighton mentioned, this is maybe the only reason for bearishness coming from the call. Ross's own guidance has consistently been below reality over the past 3 years. They have kind of a trend of guiding lower and then kind of under-promising and overproducing, if you will. Even going back to 2017, there are circumstances where they guided for a gain of 1% to 2% on a comp basis and beat it by a pretty strong margin. Now, we're not going to say they're sandbagging, but they also guided for just a 1% to 2% comp increase for this year's third quarter, a third quarter that came in at 5% on the comps front. Now, not that anyone cares, but we're projecting comps in the 3% range for Ross for the fourth quarter, spurred by greater inventory levels surrounding the holiday season. Also, they themselves mentioned on the call that weather impacts have been historically flat for them. So Leighton mentioned they were worried about an isolated weather event potentially hurting them with that shorter shopping season and not enough time to recover from them. Unlike a retailer like Target, who last week credited a late Q3 temperature downturn for strength in apparel, we've seen Ross be mostly flat surrounding weather impacts. So that's kind of interesting, especially for a retailer that does a lot of apparel, but that is what we've kind of historically seen. So barring a massive ice storm or something like that that keeps people across the country from getting out into the stores, we see those numbers coming in above where Ross is guiding. Now that we've discussed the numbers, let's talk about their initiatives for the fourth quarter as revealed on the call. The prepared statements were rather terse and to the point. Actually, the Q&A, we went there for true detail. Wasn't a lot of detail on the Q&A either. Ross historically doesn't break down things across the chains between DD's Discounts and Ross. They don't historically break down the categories too much, and Rentler was pretty terse on the Q&A as well, despite the fact that they had a great quarter. Now, looking at those details, we mentioned in our projection for Ross that inventories are up. They're up on an organizational level, but mainly because of an increase at the store level. We talk about pack-away inventories for all of these off-price retailers. Well, it's in-store inventories that were up 3% over last year at the end of the third quarter for Ross. Now, this is crucial for them as they've gained a bit of a reputation for being slightly picked over by the time December 24th comes around. Boosting their merchandise levels and perception of in-store fullness is critical for them as they continue to attract robust holiday traffic. There's a bit of a caveat to this, of course, and that's that additional merchandise must be merchandise that their core customer truly wants. They can't just bring in any merchandise to fill the store shelves. However, given their buyers' recent track record of success in this area and their low level of merchandise markdowns historically due to clearances, we feel pretty comfortable saying they've got a good pulse on the situation, those buyers do. To that point, Rentler actually mentioned during the Q&A that as a company, they see a lot of potential to their build-out of specific gift items in store, so not necessarily apparel, but some of their gift extensions. They focused on gifts throughout the year, but have really ramped up inventory in this area with the expectation that the value proposition can drive sales beyond the traditional categories for them. Despite their efforts to ramp up buying, pack-away level remains lower for the company than anticipated. It's 39% versus 41% last year. Still a greater number than what we'll talk about with Burlington, but lower than in the past. However, they record that pack-away number in relation to the size of the company. So given the fact that they've grown, given the fact that they've opened new outlets, on an absolute level, pack-away is actually up over a year ago. Even still, they were clear about the need to continue to bring in merchandise while praising the selectivity of their buying team, noting a lot of options out there for their buying team and confidence that they'll continue to get the job done. We also mentioned their new stores contributing to sales increases. They finished off their store openings in 2019 by adding 30 new Ross and 12 new DD's Discount locations. In 2019, they opened 89 stores in total. Again, as we've been referencing for some time now, Ross is attempting to grow out the DD's model aggressively. We see with the openings in the third quarter that the number of DD's locations opened in comparison to the number of Ross locations opened exceeds the current ratio of dd's to Ross stores already open. After this last quarter, they now have 259 total dd's locations after this year's slate of openings. And one of the interesting things with those dd's locations, a lot of their signage, a lot of their in-store approach is bilingual, because the Hispanic community, they have noted, is a big driver of sales at those dd's discount locations. So something to keep in mind if you were to go into one of those dd's discount locations. Another interesting thing is that this year marks another circumstance of them attempting to open new locations all by the third quarter's end, basically making sure that their opening program for a year is finished by the end of the third quarter. Now, Ross traditionally does this to attempt to kind of entrench the locations in their communities prior to the holiday rush. Again, serves a couple of purposes, among others, for them. One is for area residents to, of course, find the Ross, take note of the fact that the Ross is open, shop at the Ross for the first time. The second is to ensure that staffing at the stores become acclimated to their operations, to their systems, which helps when traffic begins that holiday uptick. And if you've ever gone into a Ross store during the holiday season, you know exactly what I'm talking about, in that it can be an absolute zoo in there. So the fact that they're getting their employees trained, getting them used to those systems before the holiday season is a benefit for them. Opening stores in the fourth quarter, meanwhile, would be tantamount to tossing their new staff into the fire, which Ross would rather avoid. So they've finished off their store opening program by now. So 89 stores, all they're planning on opening for 2019, and they're looking forward now to that strong holiday season with that fully trained staff in those new stores.
Staffing is always an important feature for any retailer. They did also mention briefly in prepared statements that freight was a bit of a headwind, and they were asked about it a little bit more in this Q&A. Travis Marquette, their CFO, noted that wages were pretty much the largest expense in this area. They recently increased their company-wide minimum wage to $11 an hour, which was, of course, extended to distribution centers as well. This, along with California minimum wage increases, which, of course, also impacted DCs and the surrounding California headquarters, adversely impacted their freight costs. However, fuel was not mentioned as a headwind. It was simply that DCs were impacted more heavily than stores in terms of their staffing levels and the hourly wages they have to pay out. They did mention briefly that home as a percentage of sales was up as a category. It now accounts for a little more than a quarter of their overall sales. Additionally, they are very happy with the momentum in both kids and toys, although they weren't specific to the extent to which each was up over the last year, but still nonetheless good categories. They did note, despite Rentler's comments about being really the happiest with the ladies category, that kids was the top performing category in the third quarter. Finally, they were asked on the call about the long-term potential for launching an e-commerce business like TJ Maxx has actually done in earnest. Michael Hartstrom, their COO, was steadfast that their view regarding e-commerce has not changed as of late, and that they expect Ross's model would not be able to work with an online environment, at least again for now. Specifically, he said that because their average unit retail, or AUR, is between $10 and $11. And if you look, the expectation for free shipping and free flowing returns now make it such that it would not be economically sustainable for them in the long term. Additionally, it would require significant DC investment, that is distribution investment, from a lot of different areas. You look at a place like Target or Walmart currently, they have invested a lot of money and they have the capital to spend, and now the infrastructure to back it. It would be a huge undertaking for the company if they did this. And since TJ Maxx, really, as an example, features different e-commerce products available than what would be available in any given market store, it would be considered a little bit cumbersome. Instead of focusing on e-commerce, they want to instead focus on their brick and mortar build out, and that's about 100 new stores per year. That's the current pace. Their focus for the intermediate term, we should call it, is the Midwest, making sure that the market is saturated before moving into the northeastern part of the United States. Fast forward to this week as Burlington released earnings just prior to us recording this podcast on Tuesday, November 26th. Like the rest of their off-price brethren, They beat on analyst expectations and saw a significant nearly 10% bump, Trent, on share price immediately after the call and the report came out. Analysts expected earnings per share numbers to come in at $1.41, and adjusted earnings per share instead came in at $1.44. A little bit of a beat there, healthy enough. Interestingly, this beat and upward movement of projections caused a greater share price jump than we were actually expecting. Burlington is a really much smaller in terms of store count across the United States versus TJ Maxx and Ross, but they are growing at a rapid clip. A lot are actually taking the place in my area in Southern California of old Toys R Us locations. I've noted 3 in the last 6 months. Also, one taking sort of maybe a 1/3 amount of space from an old defunct Sears location. But they are guiding for 51 net openings this year, which is around an 8% store count growth over their last fiscal year. Overall, now they have around 720 locations, and unlike Ross and TJ Maxx, do not have additional brands under which they hold physical stores. So it's going to only be Burlington branded stores for them. One other quick thing to note, they recently had a leadership change. Michael O'Sullivan taking over recently as CEO after the reins were handed off from Tom Kingsbury. Let's get to the call, Trent. A lot of interesting facts here. Again, earnings numbers were positive, posting a beat over analyst estimates. More so than this, their growth in profitability was notable, increasing 26% year over year. Earnings per share were up 29%, by the way, as a result of some share buybacks for the company. A big reason for this jump was not only being more effective on their net revenue, but also their efforts to reduce inventory, which we'll get to in just a second. Same-store sales were also a bright spot for the company, coming in at an increase of 2.7%, slightly above inflation there. The number in isolation isn't as great as, say, Ross, but did come in at the higher end of their internal guidance. They were concerned because they anniversaried strong 4.4% comp increases from the third quarter of last year, but still saw notable advances. And they say that overall sales increase of 8.6% was a really good thing for the company, a function of same-store sales and those new store openings. They expect to see similar same-store sales in the fourth quarter, guiding for around 2 to 3% increases there. As far as margin was concerned, and this again is going to be a theme for this podcast, their merchandise margin went in the same direction as it did for Ross, providing a 30 basis point increase on gross margin. Freight costs and inventory write-offs accounted for negative margin impacts.
And we'll talk a little bit more about those inventory write-offs as we go. One quick note regarding Burlington. Leighton talked about the new stores that are popping up in his area of the country, which is in Southern California. They actually mentioned the southwestern United States as their highest performing region during this past quarter. Now let's talk about inventory, as we're doing with every off-pricer in this podcast. They've been striving to actually go the opposite direction as TJX and Ross by reducing inventory. The reason for this was somewhat complex. Their reasoning basically is that if they could reduce both in-store and pack-away, or as they call it, pack and hold inventory, it would increase their ability to take advantage of buying opportunities in late 2019 and early 2020. Or as they said on the call, the flexibility to be very opportunistic. So this kind of indicates a couple of things to us, but the main thing is that their pack-away space is finite and their liquidity is a little bit finite. They can't just go out and negotiate deals, have their buyers acquire merchandise all willy-nilly and bring that in, because they might not have the room or financial flexibility with which to do so. So if they're making room for those deals, that's kind of what that tells you, is they see inventory as a zero-sum game where they've got to clear some out in order to bring some in, which is a little bit different from the earlier two retailers that we talked about on the call. They're seeing a decrease in comp store inventory by 4% if you use the numbers at the end of this year's third quarter over the same time last year. Additionally, pack and hold inventory as a percentage of inventory has also declined from 18% to 15%. Now, we talked about Ross. They saw a decline in pack away, but an increase on an absolute basis isn't the case here with Burlington. Now, there might be a kernel of sense to their reason for inventory shrinking in this era of excellent available deal flow for off-pricers. Their overall inventory was around $1.056 billion on November 3rd of last year. It dropped all the way to $954 million on February of 2019, so after the holiday season. As of November 2nd, as they were able to leverage this deal flow, it was back up nearly 5% to over $1 billion. They see liquidity fueled by lower inventory levels as allowing them to chase those in-season trends. Again, kind of referencing that zero-sum game I talked about a little bit. Even still, it's a bad sign to us that they said on the call that they expect inventories to be down over the same point in the prior year by mid to high single digits after the fourth quarter. This isn't a place we saw as being an area of opportunity for them. So while it does help the balance sheet in the short term to kind of shed those inventories, it's going to make the profit numbers look a little bit better. We feel as though the decreased inventory levels might be a net negative overall, especially given the increase in store count. Remember, they are increasing store count by a significant margin. As we discussed with Ross and TJX, there can be nothing worse for an off-price store than to have a low selection in December. It appears as though Burlington may be headed that way. And keep in mind, we talk about inventories. A lot of the Burlington stores are larger square footage stores versus those Ross outlets or versus those TJX outlets. As far as other key points on the call, O'Sullivan was asked what changes he foresees making as the new CEO of the company. He actually said that part of the reason he elected to take over at Burlington was because of the overarching ideology of leadership regarding off-price. Rather than changing anything, he simply mentioned just strengthening the company surrounding the key tenets that are already in place. In O'Sullivan's words, and I'll quote this, "We're an off-price retailer. Off-price is winning. We need to get better at off-price." And later he said that they wanted to be, and I quote, "more off-price." So very bullish about off-price there, just wanting to be further entrenched into that category so that they're not an afterthought when you think about those off-price retailers. Now, John Crimmins, their CFO, did come on to the call to mention a few negatives. First, they had 7 stores unexpectedly closed for long periods of time during the quarter due to building-specific issues. Something they discussed that I don't think we've ever actually talked about on the podcast in the past is damage to stores and inventory from fire. There was a 10 basis point impact, in fact, from inventory write-offs as a result of these fires. They said that negatively impacted comps, but also that inventory write-off negatively impacted earnings per share by about 3 cents per share. Now, all but 2 of those stores currently are reopened. They're still working on the other 2. But again, negatively impacted comps cost an estimated $9 million in sales. So whether you chalk this up to bad luck or something else, when you have fewer stores in your system, these type of problems really magnify the overall financial picture for you, as is the case with Burlington. Additionally, another negative for them was the lack of momentum from new store openings. And Crimmins said specifically on the call that non-comp sales or sales from new or relocated stores were less than expected in the quarter. And again, this is a negative for them, and a pretty significant negative, despite the fact that we saw the share price nearly pop 10% in trading today, so Tuesday, November 26th. There are some negatives to take from this call, and the fact that they're so bullish on these openings, yet these new stores aren't pulling in exactly what they wanted in terms of sales. Kind of some warning lights on the dashboard for Burlington, but not all of it was negative, Leighton.
No, it certainly was not. On the opposite side, they were able to save some money on utilities. Again, not something we hear about that often on these retail reports, and common area maintenance charges. And if you look through a lot of different rental agreements, it can be a little boring sometimes, but oftentimes you hear about leases, Trent, with especially national credit tenants, which are typically your larger retailers of the world, where they have to pay. They're on the hook for things like parking lot maintenance, lighting, fixtures, those kinds of things. And all of those common area items, they can add up year over year. You have to maintain those items. So oftentimes you can renegotiate those leases and then take some of those charges or potential charges out of those leases, depending on whether the landlord is ready to fill that space with another tenant, or is really thinking that their best fit is to have that retailer stay. Finally, they noted strong categories for them. This included home, Missy, kids, and accessories. Home now makes up around 15% of the store, not as much as TJ Maxx or Ross outlets, but more than previously was the case for Burlington, which in the past was not as well known for such things. Missy relates to women's apparel, by the way, specifically sportswear. They noted this as the most positive apparel category for them. Also, of note, they talked about beauty and toys as areas of opportunity for them. Beauty was mentioned as an opportunity as well for TJ Maxx and Ross. As far as toys were concerned, they feel positive about their assortment in stores currently, but were clear that the next few weeks were truly going to tell if their investments over the last 2 years in that category will end up paying off. Overall, these were solid results, but there were reasons to be concerned, or are reasons to be concerned, about Burlington long term. We've been bullish towards them, but if anything, this call made us a little bit less so.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
We've reached the final segment of the Retail Focus podcast, a segment we call Looking Ahead, where each Leighton and I talk about a story we're keeping an eye on for the next week, month, or year. And Leighton, I understand you're kind of going with the craft space this week.
Yeah, a space that we don't talk about too much on this podcast, but an important space nonetheless. New Jersey-based arts and crafts chain AC Moore is actually closing all of their stores, 145 stores around the United States. Its parent company actually said in a news release on Monday that the closings are going to come as sort of a reconstruction, if you will, reconfiguring of the company. However, there is positive news here in that we talk about commercial real estate investment all of the time in the retail dynamic when you see that brick and mortar is dying and there's going to be abandoned stores left throughout the United States. This is actually a positive news story. It's a really larger opportunity for other stores, both in the craft space and other stores, to scoop up some of that potential real estate, not to buy necessarily, as most of this is rented real estate, but up to 40 of those closing locations are going to become Michaels, which is a direct competitor, or soon we could say was a direct competitor to AC Moore. And you look at AC Moore, Trent, they've been in the industry for over 30 years, and they had a very specific niche. They had a lot of followers that would come in, day out for their different creative projects. And if you look, maybe you could say that Michaels isn't going to be tailored towards those specific customer demands, but they're looking at these different spaces as opportunities for them to grow their own business. I think that's a very, very good thing, even though we are talking about sad news with another retailer closing over 140 doors throughout the United States. Again, not the best thing in the world, but AC Moore's website will actually stop accepting online orders on Monday as well. Something that a lot of people were scratching their heads at, thinking that, well, they do have a brand, so potentially you can extend or sell that brand and create long-term value, a lasting legacy, if you will, but that appears to not be the case. But nevertheless, I'm curious to see what happens with those other over 100 buildings. Who's going to be taking over those leases? Who's going to be taking over those spaces? And what, if any, redevelopment is going to happen with AC Moore? But as of now, Trent, it looks as though, again, the New Jersey-based arts and crafts chain is going to be gone forever.
And this is kind of a different approach that they're taking because, as you mentioned, the website typically is the last thing remaining. HancockFabrics.com was available well after Hancock Fabrics actually went bankrupt. They were also taken over by Michaels. So kind of an interesting thing that the website is ceasing to accept online orders and that it's happening so quickly, just right here in the midst of the holiday season. So you kind of wonder what was going on there that they couldn't make it through the end of the year. It must have been really a dire situation. But Michaels, a chain that's had some success of late, as has Hobby Lobby. And so Again, look forward to their plans for those closed stores. Another chain that's had some success of late, Dick's Sporting Goods, and they have to do with my looking ahead. They just posted earnings this week as well. It's been a solid earnings week, by the way, in general, but Dick's absolutely crushed analyst expectations. FactSet analyst expectations for them on earnings, 38 cents per share. They came in at 52 cents per share. So a great showing from Dick's. Same-store sales were up 6%. The reason I'm looking ahead is because we do have the holiday season coming up, and Dick's actually announced that it's the bigger ticket items that was helping to fuel same-store sales and traffic. This is unique for them because they've been talking over the last couple of years on their earnings calls about introducing private label goods, introducing more clothing products. They haven't been talking about the big ticket items quite as much. So it's interesting to see the big ticket items are really fueling this growth for them. My looking ahead, not necessarily limited to Dick's, but the entire sporting goods industry, these larger ticket items sometimes are easier to purchase at these brick and mortar locations, and we've seen a movement away from brick and mortar in sporting goods. So will other sporting goods retailers, Big Five, Hibbett, and several others, see that same benefit from those big ticket items this holiday season as we see discretionary spending go up, even as consumer sentiment kind of wanes as we get closer to the holiday season? Can they benefit from it from November to December? That's really what I'm looking ahead to, specifically as it pertains to the big ticket transactions, because again, not something that's been talked about, whether it be on Dick's earnings calls or Hibbett's earnings calls or anything like that, but something that really showed out in this quarter for Dick's, and I'll be eagerly awaiting their results from the holiday season, as well as Hibbett and Big Five, and you can guess that we'll probably cover one or more of those on the Retail Focus podcast. Well, that'll do it for this truncated edition of the podcast. Next week, we'll be back with a full-size episode. We've also got an interview tentatively scheduled to talk about apparel retail. We're very excited about that. So everyone have a great holiday, and we'll be back about 10 days from now.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.